Well, first of all, thank you so much, Arvind, for organizing this conference and again for inviting me to be a part of it. We've had an exciting day, and I think today will be just as exciting and just as informative. So I'm very happy to be here today for today's morning session, where we'll have Amiyatosh Purnanandam and his co-author Tamanna Singh Dubey. Amiyatosh will present a paper on cashless payments in India and the effect on growth of what has been a revolutionary fintech development in India. So, and our discussant is Isha Agarwal, and sorry, I kind of left out everybody's affiliations here. So Amiyatosh is a professor of finance at the University of Michigan, and Isha is an up-and-coming scholar and assistant professor of finance at UBC, University of British Columbia. And my name's Nandini Gupta, and I'm a professor at the Kelley School of Business, Indiana University. So yesterday we heard some yesterday's first session, for example, we heard some controversial, statistics about the effect of COVID on India's economic growth. What is far less controversial is the fact that since COVID, there's been this huge expansion in the adoption of cashless payments in India. So, for example, some numbers that you're going to see shortly from Amiyatosh's presentation is that regarding the volume of transactions. So we went from something like 1 billion transactions in 2019 to post-COVID numbers of 8 to 7 billion. So these are, this is an astounding development. So I'm very interested in seeing, what Amiyatosh and his co-author Tamanna will show us. So without further ado, let's go ahead and get started.
All right, thanks a lot, Nandini, for that introduction, and thanks to everyone here for inviting us to talk about this important issue. Can cashless payments spur economic growth? Tamanna is one of my very smart PhD students. She will be on the job market in a couple of years. So we have been thinking about this idea of cashless payment, of course, fintech revolution. That has happened not only in India, but a lot of people across the world are thinking about it. And does it matter for real effects? So that is the key idea. And the basic economics of this is pretty old. Goes back to the idea of, does cash matter, does money matter? And if you think about the old debate that Lucas and Stokey and a lot of people had in monetary economics, was that, look, the basic idea was that any form of money can be quickly liquidated into another form, and it doesn't really matter for your transaction. So that was the frictionless benchmark. So in a world when there is no friction, whether I'm holding cash or digital asset or even a bond, I can quickly liquidate and meet my needs. So that will affect consumption, that will affect production, and so on. So this whole literature, old literature was more theoretical, and there the question was not so much about, which is our question today, does the means of payment affect economic growth? That is, if you move from cash to cashless, does it affect economic growth? And the idea has to be that there are some frictions that make one form of payment more attractive compared to the other. So with friction, then, it becomes an empirical question, which is what we are going to tackle in this. And the idea is digital payments it's still an evolving literature. The way we have categorized the frictions broadly in 3 categories. And we have talked to people on the ground in India who are doing these things. So I'll give you a few examples on that too. So one is that as we move to digital payments, the transactions cost comes down, which should be straightforward, whether it is in terms of a speed of transferring money, or it's in terms of the cost, which could simply be going to your next branch, which can be 30 kilometers from where you live. So the speed and cost, and also safety. In many parts of the country, or somebody was telling me here in the New York City many decades ago, transacting in cash can be problematic, and if you can move to electronic payments, then it is safe. So we are calling all of that transactions cost friction. And of course, if I move from to a means of payment that has lower transactions cost, it shows for economic growth. The important thing that people like us in finance and banking, equally important rather, care a lot about, and there's a huge literature on what are the frictions in credit creation. So what are the credit constraints that we talk about? And initially, we thought it's mostly about, that is, the digital payment will help with information. People become bankable, their information becomes digitized, so you can lend to them. And a lot of fintech companies, lending companies have come with that idea, right? And so we have talked to a lot of people there, at least the CEO of one of those companies, and got a lot of examples of how they do it. For example, they will set up a digital payment system, just like a Square or Block here. And then initially, they'll only do digital payment transactions. So the shopkeeper will simply be saying, this I'm talking about Kirana shop, mom and pop, small shops, right? So I'll set up a digital payment for you, so you don't have to worry about payments. And once I get the information, then I'll make a loan. And in fact, this particular company, my anecdotes are really a little bit helpful. Passes Praveen's smell test from yesterday, is that sometimes they will give them just 1 lakh rupees of loan, and just to get this information. And once that becomes better, then later they'll give them a 10 lakh rupees loan or a 50 lakh rupees loan. The other thing which was also very important, they did not put it in these many words, but effectively improved contracting and improved enforceability of contract. That is, if I have the information flow and the payments are coming in, then 2 ways you can improve the enforceability of contract. Or one is writing better contracts. So there are contracts coming up where you are, unlike traditional banks, where you'll do a quarterly or a monthly payments schedule, you can really tailor it to the cash flow pattern of the borrower. You get to see the cash flow, so you can write a contract that is matching the debt repayment with the cash flow. And the second one is that there are contracts being written here in the US also, where you can tailor it to the revenue of the firm, and in that case you have a better access to their cash rather than waiting for the end of the day and then getting your repayment back. So the screening and monitoring costs, broadly we'll talk about credit constraints. So we are talking about transactions cost and relaxation of credit constraints. All right. So from India, of course, in this audience, it should be straightforward to say that, look, and I'll show you some graph, but this we have seen a lot by now, and yesterday also we talked about it, that there has been a massive growth in digital payments. And there are a series of reasons that it has happened. And we'll talk about that in a second. And the other reason that it is very attractive, that we literally moved from a cash-based economy to a cashless economy in an aggregate sense. So at some level, the credit card and other forms of electronic money, we escaped. I mean, of course, there was credit cards and so on, but if you go to rural India, if you go to a small shops, there has been a massive change on that front. And third, which I'll talk a little bit more about as I go along, is that we will be using this CMIE data, and Arvind has given me a lot to think about on that, but I'll tell you that how we're using that data, and in this context, it's a very useful thing to do. So I'll wait for that when I present my results. All right. So the reason that I wanted to talk about, India is just a setting. People are talking about this in China, people are talking about it in the US, people are talking about in a lot of African countries, Asian countries, that should we go for digital payments? And one of the messages that Tamanna and I hope to get across is that it goes beyond just a means of payment. It matters for economic growth. So here is, in fact, New York Times had an article about a month or 2 ago on digital payments in India, where they captured the essence of this massive growth. So this growth happened after 2016. There is UPI, of course, that we all know in this room. I'll talk about this a little bit more. But on the chart, you see the big thing is there is slow take-up after 2016, after demonetization. Around the same time, you had all these electronic payments coming up, and it was going up even before COVID. It was going up even before COVID. And then you see there is a COVID shock in 2020. After that, it just went through the roof. It accelerated, right? Now, as an empirical work, you'll of course see that, look, what you have is nationwide stuff that people like us who do empirical work, of course, ideally we want something, one area got affected, one area did not get affected. This was a national change, adoption of UPI, the launch of UPI, and slow adoption by districts. We will be exploiting across district variation in the adoption of UPI, and our identification will come from that how districts that have more versus less adoption of UPI, how are they performing on economic growth. Needless to say, any study of this kind will have a lot of identification challenges. That am I linking a causal, am I making a causal statement, or am I picking up correlation? So first I'll show you some correlation, and then we'll start slowly pushing towards causal link. This is literally the first time we are presenting this paper, so there's more work to be done, absolutely, on that front. Let's start with the two maps. So what I'm showing you in green is that for every district, just one number. So of course, from 2016 all the way to 2022, we get data on transactions from PhonePe. So the leading, one of the leading providers of these digital payment services. And then we saw districts based on the per person transaction of digital payment. All right? And we do a percentile ranking. And the darker the area, yeah, absolutely.
Is the transaction only of PhonePe?
PhonePe, yeah.
Or they give you a transaction?
No. It's only a PhonePe, and one of the things which we have some later, I don't think I'll have time to get into, it tracks the overall payment very closely. So we can, that much we can be very sure about. I have been in touch with NPCI, and I'm hoping that I'll get the whole thing, but I don't have it yet. But yes. So it's a PhonePe data, fairly representative in terms of the time series correlation between, because we get to see the national aggregate and the PhonePe aggregate. PhonePe has more than 50% market share in the area. So what you observe here, so, and then side by side in blue, we have the measure of financial development, to be precise, how many bank branches you have per 1,000 people. But again, I'm presenting that on a percentile basis, ranking. Now, what you see here, some obvious things, that if you look at the dark on the green side, if you look at areas that are dark, that is where there's a lot of intensity of digital payment adoption, like Delhi or Bangalore or Mumbai, no surprises. These are the developed parts of the country. But what you also see in the heartland or in the areas where if you look at the financial development, it's relatively less so, right? On the whiter side, but then there is a lot of green on those areas, those districts. So what you have is, and of course, ideally we want to superimpose these two graphs, but that's what we'll do empirically, but one picture tells you that digital payment adoption, of course, happened more so in more developed places like Delhi and Mumbai, but it also happened in rural parts of the country, and parts of the country where the traditional financial development was not high. So this gives us a setting where we can figure out that what was the effect of digital payment adoption across districts with different level of physical branch infrastructure. So the way we are thinking about it is that it was perhaps hard for a physical bank branch to go to a place somewhere in Bihar or Uttar Pradesh or Jharkhand, but the digital payment reached them. You didn't need all the infrastructure. So that is the disintermediation that happened, and it is in that sense that our paper relates finance to developmental economics literature. That's where we are headed. All right. So the key message of our paper, the first draft of the paper, we'll keep refining, is that we find a very strong pattern that after 2016, right? That is, what we're doing is, think of this, I'll talk about it later. So we are simply looking at across districts, there are a lot of households. We'll be using CMIE data. I'll talk about that on the next slides. But the key message is that if after 2016, households living in districts with higher adoption of UPI, they had higher reported income, but more importantly, where we are headed, what our focus is on, did it alleviate those frictions that allowed them more to do more entrepreneurial stuff, that more business creation, more business income. And a lot of our empirical work will be headed in that direction. That is, in districts where there's a lot of UPI adoption, do I see more hawkers coming up with their own business? Do we see more small shops coming up, the business income going up, and so on? So it's all going to be across district comparison over time. And it is in that sense that we believe that to start with, we are able to identify the first order effect of how digital payments affected economic growth. And the reason we feel comfortable with our message in terms of friction, so once we show you those results, then we ask that, so where does this matter more? That who has more income because of this digital payment shock? And in a relative sense, when you're self-employed, when you live in financially less developed districts, and it's all going to be in different settings. When you live in high crime rates area, the third result, the crime rate result, we have just started, and we need a little bit more work, and I'll tell you what more needs to be done. Quickly, because I know we don't have a whole lot of time, but I'll just say two things here in terms of the literature where our paper fits in. That there is a lot of interest now on fintech and what it means for credit creation. I think we are the first paper that looks at the real effect of fintech. That is, what it means for business creation, what it means for the income, and so on. There are papers that look at how digital payments can help you get credit. But then the next step is not super obvious. You may have prior that more digital payment should affect economic growth, but it could also be eating away from the traditional banking sector. That is it a substitute? Is it expanding the pie? Early on, at least in the context of US, the debate was, is it the fintech is simply like online lenders, are they simply skimming the top, or are they expanding the size of the pie? And the second literature that we connect to is the developmental economics and finance, where historically the whole idea was the rural bank and the economic growth, and I know there are people from the State Bank of India here, that how the banking, all the banking regulation and economic growth. Now there's a new kind of banking, digital banking and economic growth. I'll skip that. All right. So UPI we all know about. I'll continue my discussion, my presentation in the context of what is relevant for us. One of the key things that come up in the empirical exercise that, all right, adoption of UPI is not random. We are not doing a random assignment of UPI across districts. So there are reasons that some districts will adopt UPI, some districts will not adopt UPI. Now, what are the reasons, key drivers of UPI adoption? And in some sense, it helps us with our causal link, because there were a lot of things, some expected, some unexpected. Some intended, some unintended consequence of different policies that led to the different rate of adoption across different districts. And I have listed down some of them. That it started with this Aadhaar card that everybody had. We had a digital ID in the country, PM's Jan Dhan Yojana, everybody got a bank account. Then you had the demonetization shock in 2016, and at the same time, people had access to mobile phones, right? So now, all these factors varied in different proportion across different districts, giving us different path of growth, right? So it's very hard. In fact, empirically, we looked at it, and we are still continuing to do as our data becomes better, but it's very hard to pin it down if you just run a regression of which district had more, and if you pin me down that, hey, was it just demonetization? Was it just mobile phone penetration? No, it's a combination of all of this. And at some level, that helps us with our identification that I'm not, of course, saying it is random. And before I forget, and then COVID-19 happened. And then again, very unexpected shock that, and if you had the digital payment, then it became an enabler of the stuff. All right. So it's a bunch of data we are getting, and we are still in the process of expanding the set of things that we can say, including some stuff from the RBI data that we'll look at, and what Arvind was saying, that we'll look at the other data sources from labor force survey. But the key thing that we have, the reason we feel comfortable using CMI database here, is that we are not making any aggregate claim. What we are saying is that you have different households, and it's a longitudinal study. So you have different households, and you get to track them, that did they start a business or not? Did their income go up or not? And then, so we are doing that over time, the household fixed effect, and we are doing it across districts with higher versus lower intensity of UPI. So and then we are not making any aggregate claim based on that, right? Like from a macroeconomist perspective, I can see all the issues with aggregation with this database. But as a microfinance person, where all I need is that any biases, any trouble is not that systematically correlated with high and low UPI district. That is the assumption, okay? And I'll show you some reasons that why we feel comfortable about that, okay? But happy to take more. Other things I'll skip. There are standard databases. So let me jump to the empirical design, which is intensity-based definitive. That is, there's an intensity of treatment here, which is the digital payment adoption. And we do the percentile ranking just for easier economic interpretation. But so cashless intensity right there is your district characteristic. So we fix it. That based on the average that happened from 2016 to 2022, when our data is. So it's a district characteristic. And then we are looking at some of the outcomes. And effectively what we're doing is we are comparing, as I said earlier, with the household fixed effect and the year fixed effect. We are simply looking at the post times cashless intensity. So that beta coefficient tells us that after 2016, first, we'll start with that, and then I'll show you after COVID in a second. But after 2016, did districts with higher intensity of cashless payment do better in a relative sense? That is, compared to what they were doing before. And the key threat to our identification, the causal link that I was talking about, is that you, of course, should worry. We worry that could there be some unobserved thing that suddenly in Jabalpur you have a massive new project that came up, and people started using UPI there, and you see that there's more economic growth also, right? So that is the threat to identification. But it has to be something that is unobserved and time varying. That's the only thing that I'll request you to keep in mind, because if it's just about Jabalpur's characteristic, that it is high or low in financial development, that will not affect our result. That is taken care of, okay? So I'll skip the stuff and the numbers and show you a few graphs. So let me start by this graph on log income, reported income. What you're seeing here, start with the red line, and then you see that I have centered it around 2016, the standard way of showing you a parallel trend and showing you what happens after the fact, okay? And each dot there on the red is giving you that in that year, that is in 2014 or 2015, 2016 has been centered to 0 by design, but in 2014 and 15, if I looked at the effect of cashless intensity, the way we measure it, after the fact, did districts with different level of cashless payment, did people report different income in 2014, 15, 16? The answer is no. In 2014, 15, 16, on a scale basis, they were saying that roughly the same income. And after 2016, it started creeping up a little bit. It took a year or two, but by 2019, you clearly see, and then the two blue bar, you're seeing a 95% confidence interval. That is statistically significant impact. And then, of course, I'm saying, of course, in the context of the discussion that we had yesterday, that after 2020 COVID shock, these districts just went up in their income, reported income. So it is in that sense that what we are making here, the claim is a relative measure, right? That is, in a relative sense, districts that have higher cashless payment, they ended up with much higher income later on. The thing that really has caught our attention, and we are going to be working more and more on this through all sort of empirical tools that we can, is that what it meant for business creation. So we first just started by looking at the proportion of people who are reporting their own business, right? That is, and this is very consistent with the kind of stories that we hear, that a lot of people have started their own shops. Of course, now you don't need the whole credit card system that costs you a lot. So one is simply that transaction cost, and the second is that now you can get more credit. So both these will, in fact, help you create more business. And that you see a big spike. But again, this is in a relative sense. So we are not saying that just after 2016, in the aggregate sense, there was more spike. But there was like 5-6% higher probability of starting a business, which went up to about 10-15% later, and then stabilized at that level. So all we are saying is that in the high cashless intensity districts, you have a much higher probability of starting a business. Yeah? Sure. We do the percentile, yeah. No, the whole, the 570 districts for which we have the data, we just rank them from 1 to 100. That we just did for easier thing, but you could go with a log, UPI, but this is all I'm showing you the percentile. So that you can just say that if you move from 1 to 100 percentile, then what happens? That it goes up by 10% probability. Okay. All right. So now you put it in these standard diff and diff regression, and some of the things that I already showed you with the picture, so I'll be quick with that. But this, of course, allows us to control for a lot of other things in the regression. The figures only go that far. So the first column tells you that there is the cashless intensity, if you go from nothing to a lot, of course, every district had growth, so it's, then you ended up with 1.65% higher income when you move from the lowest to the highest cashless intensity stuff, which we feel it's a reasonable estimate, and it's not too small, not too large, but of course that depends on your prior. Now, in the regression setting, we can also control for a bunch of stuff, that is it rural, urban, and one of the things that early on we were thinking about both with the CMIE data and all the transfer schemes that happened in the country, the migration that happened in the country, that had the path of rural, urban be different, in a sense that it may be correlated with the cashless intensity. And then our results of the first column becomes stronger, but more importantly, the third column is where we separate the effect that happened after 2016 and the effect that happened after 2020. That was the post-COVID. Now, and there are two ways to interpret it. Not two ways, but let me just say this. First, when you look at the post-COVID / cashless intensity, you clearly see that the effect is much larger, as you saw in the graph. But what we are finding is that this is not just a post-COVID effect. The effect, just as you saw in the graph, started in 2018-19. And the discussion yesterday that some of you were having is that the country was ready when COVID shock hit. It's like that it was going up, and because of the digital infrastructure, after COVID, you went up. So now you can interpret it two ways. One is that some of the effect that we're saying is not because of the credit constraint friction, but it is that COVID happened and everybody just was afraid to do physical. So in that sense, there is yet another transaction cost, extreme form of transaction cost, which is perfectly fine for our study, but we want to be careful in saying that, look, we hope that we don't have a shock like that again. So, but the top line is independent of that shock, okay? All right. How much time do I have, Nandini? Okay, thank you. Now, in terms of the business, so I'll show you two things here. that is that the probability of owning business, and here we are doing just 1, 0. And here we are doing how much business income they reported. So we feel very comfortable with this in terms of the reporting bias. That is, here you're basically, unless you forgot that you have a business, it's like very cleaner data that is a little bit less informative, but simply saying that do you have a business income or not. Yeah? And the same effect, that is, you have a much higher level of both the probability, and then the other one is, the last one is business income, where it's a log 1 plus business income, because a lot of people have 0 business income. So that's a little bit hard to literally translate. So just wanted to give you a caveat there. Okay. So as happens with these things, so think of them as correlation, a little bit better than correlation because of the parallel trend that you saw. That makes it a little bit better than just a cross-sectional correlation. But the real issue for us is that, well, there could be something time varying that affected both the economic opportunity in an area and the adoption of cashless payment. That is the holy grail of our exercise, any exercise of this kind. So we lean on theory and a little bit of empirical strategy we use in our business to say something more. And here is the idea, that the very first slide when I was talking about that does means of payment affect economic growth, it has to be that it has to come through some friction. So, and those frictions I spent good time talking about, credit constraint friction, transaction cost friction. So now what we're doing is we'll go within a district and we'll look at people who are more likely to get some relief on that friction after digital payment. That is what we are saying. That is, if you are, suppose start with a set of people who are self-employed, who are entrepreneurs, versus salaried people. So the first group, the self-employed person, so both group will benefit in terms of doing the transaction. That is, they are both, the identifying assumption is that they're both making the transaction, but the self-employed also gets this extra kick. That is, the credit constraint has been relaxed. They can start a business. And under that assumption, what we'll be doing now, that we can put in district year fixed effect. That is a more fancy way of saying that is anything that is unobserved at the district year level. If it's Jabalpur in 2016, holding that fixed, we are saying that in Jabalpur in 2016, do hawkers, entrepreneurs, are they doing better than other group like salaried people and so on? So that is the key identifying assumption. Okay? So within district year fixed effect. I hope I got the message across. Now, so we do the same outcome variable, and then what we do here is put the household fixed effect, year fixed effect, and now the district year fixed effect. Right? Some of this will be, of course, soaked up with each other. And then now it's the triple interaction that is of interest to us. The triple interaction is saying that after the UPI boom, 2016, when the cashless intensity is high, do self-employed folks do better? Okay? Do self-employed folks do better after 2016? Holding fixed those unobserved shocks at the district level. So that's where the granularity of data we like. Okay? So there's always a trade-off, but what? Let's pay attention to the triple interaction. And needless to say, with triple interactions, there is always a little bit of you're thinking in 3 dimensions. So you think about post, you think about high cashless intensity, and within that, look at self-employed versus not. Now, it's not obvious, of course, the way we thought about it, self-employed versus not, but in data, then again, you have to make some calls. That who do you call self-employed? Who do you call not self-employed? So we do a series of things, but I'll just show you. And they just they identify that, hey, I have a salaried income, I'm a salaried person, or I'm a self-employed. So in that sense, this is useful. So I'll show you a bunch of stuff where first we say that, look, anyone that is not, that is an entrepreneur or a farmer, and in this definition of credit constraint, even the farmer is getting credit constraints relaxed, all right? So, and what we leave in the comparison group are people like salaried people, people who are retired people. That is the group comparison group. And across the board, what you find is that the triple interaction term is positive and significant. That is, these guys are earning higher income compared to salaried and other folks in the same district after the shock. The last column, which we find a little bit more interesting, it's not there in the paper. There we compared hawkers to laborers. So one of the things that we saw earlier, that people said, look, if you compare self-employed with the salaried people, you're also comparing formal, informal, and there's those things. So in the last column, what we do, we say, look at people who are they identify as the small business folks, and then people who identify as laborers. So their income is all coming in the informal shock. And the whole idea is that if there is some informal economy boost in that year, in that district, we soak it away. So that's where we have gone so far on this route in terms of the identification. Two things I must say, and love to get your feedback now or later, is what we are looking for, and we'd love to get some ideas on that. But we have been thinking about exploiting. There were a lot of incentive schemes and promotion schemes that different state governments came up with. That will give us some heterogeneity in the adoption of UPI. For example, the government of Assam started giving some extra. If you use digital payments on a petrol pump, they'll give you extra 0.5% or something off. But we yet do not have any systematic way of sorting estates into those things. But that's where we are headed in identification. All right. Now, that was a little bit about the statistical thing. But let me show you something which we believe is more interesting on the economic dimension, the channels. That is, we say those things, but does it matter? And does the channel of credit constraint matter? So with the three variables, with income, probability of owning business, and the income that you got from business, we run a bunch of regressions now, where the whole idea is that we will estimate this effect separately across districts that differ based on their financial development, based on their physical financial development, measured by number of bank branches per thousand population. And what you see here, let me just do here. So here we simply, in the last three columns, let's focus on that. We just created an indicator variable where a district that is in the bottom 25% in terms of bank branch penetration, we call them 1, low financial development, the rest we call 0. And what you find is that the triple interaction is positive and significant. That is the map that I had shown you earlier, that the effect of digital payment adoption on these outcome variables is stronger in districts where you did not have a whole lot of physical bank branches. That's the simple way of saying that, which is consistent with our idea. Now, this one I'll put a caveat, because once we put this out, we learned that estimation of crime rate is not that straightforward. There is reporting bias here too. So we'll clean it up. But the first thing what we did, we simply took it from the National Crime Reporting database across districts. If you just look at that, then you find that in the high crime districts, the effect is stronger. We are cleaning it up, and I put a caveat on that. The 3 minutes that we have, let me just show you a little bit about what it meant for the credit constraints by looking at, did these households borrow more? Okay? So the database tells us that borrowing, and we find that consistent with the credit relaxation channel, in areas with high cashless intensity, the probability of borrowing, and by all we simply mean that borrowing from any source, that did you borrow or not, that go up. And then did you borrow from bank, that did go up. And then finally, did you borrow for business, that go up. That is, the respondents are saying, so what did you borrow for? Did you borrow for business, or did you borrow for personal consumption? All right? So that is consistent with what we will argue, the channel that we have in mind about. And then this is more of the same, that the borrowing across different financial constraints, that where did the borrowing go up? The borrowing go up in districts where you did not have a whole lot of physical branches. So I'll conclude here. And the broad message where we are, as I said, the very first time we have presented, the early results are that we look at the effect of digital payment on economic growth. It is coming through business creation. It is coming through partly both transactions cost reduction and credit constraint friction. And going forward, we will certainly clean it up more, and I'm looking forward to Isha's comment, which I'm sure will help us improve the paper. Thank you.
All right. Good morning, everyone. I'm very happy to be here today to discuss this very exciting paper on digital payments. Thank you, Arvind and Nandini, for the invitation. Okay, so what does this paper do? It takes us back to this old and important question in economics about whether the means of payment itself can affect economic growth. And it tries to answer this question using the UPI launch in India, which led to a staggering increase in digital payments adoption. The empirical methodology is a difference in differences analysis, where the authors exploit differential intensity of digital payment adoption across districts and across households within districts to say something causal about the effect of digital payments on economic outcomes. So what are the main findings? The paper finds that households in high digital payment districts started new businesses at a higher rate and had higher business income and total income. And there are two key mechanisms that explain this finding. The first mechanism is that digital payments reduce the cost of cash transactions. And the second mechanism is that digital payments reduce financial frictions in borrowing or financial constraints that potential entrepreneurs face when they have to start a new business. And in India, it's very intuitive to think about the cost of transaction. So if consumers have to travel 20 kilometers to walk to the nearest ATM to withdraw money, then that's costly. Especially in high crime areas, safety is also a concern, so cash imposes a cost. So that's the cost of transaction. And the paper finds that the results are stronger in regions with fewer bank branches and high crime rates. So that sort of validates the cost of transaction motive. The second friction is the financial friction in borrowing, which is that small companies or potential entrepreneurs, they don't have credit history. Credit score may not be the best indicator that banks use to give them a loan. So these types of entrepreneurs are generally not able to get a loan from a bank. Now, what do digital payments do? Digital payments create a digital financial footprint through these financial transactions online that banks can use as a source of information about these potential entrepreneurs. That helps ease the financial constraints that these potential entrepreneurs face, and that helps in business creation. And the paper finds that households are more likely to borrow from a bank in the post-UPI period, showing that financial constraints are in fact being eased. So let me start off by setting the paper in a broader context. So the global economy is in the middle of a digital revolution right now in the monetary system. And I see the monetary system as having two key components: money, of which currency is a part of money, and payment systems. Now, money is the medium of exchange. This is what agents use to settle claims. And the payment system is the set of rules and underlying infrastructure that determines the technology of that exchange and underpins the efficiency of that exchange. And we have seen innovation on both fronts. So on the medium of exchange, historically, if you go back to the 900, 800 BC, cattle was used as currency. People used to settle claims using exchange of cattle. Then we had metal coins, gold standard, and right now we have fiat currency, which is intrinsically worthless, but has the government decree. It is what is used to file taxes. And right now at the frontier, we also have central bank digital currencies and crypto assets, which can compete with fiat currencies. On the other hand, we have innovation in payment systems, where innovation can happen along multiple dimensions. One dimension is whether the transaction is settled digitally or physically using cash. Even when you talk about digital transactions, you can make a payment online using a credit card or a debit card, or you can make a payment through your mobile phone using an app. That is transferring money directly across bank accounts. Okay? Similarly, this digital transaction can be either real-time or deferred settlement. Real-time is, for example, phone pay using the UPI system. Deferred settlement is, for example, the PayPal app in the US, where if you're sending money using PayPal, the person may receive the money after some time. Similarly, you can have overlay or open systems, which is Google Pay through UPI, where at the front end, you make the payment using Google Pay, but at the back end, the authentication of that payment and the settlement is happening through the standard procedures set up in the existing infrastructure already. Versus there are closed loop systems, which is, for example, WeChat Pay and Alipay, where from the back end, from the front end to the back end, everything is owned by the third-party app, which can lead to concentration in the system, in the space. Okay. So in this context, this paper is going to focus on innovations in the payment technology, and in particular on this aspect of digital versus cash transactions. It's important to note that fiat currency, rupee, is still the legal tender. We are not talking about digital, central bank digital currencies here. That creates a whole other, a host of other questions about monetary policy and what is money, which this paper is not talking about. It's talking about innovation in digital versus cash payment. Okay, so I think that this paper makes a very important contribution to the literature. It talks about the broader question of the effect of cash on economic growth that economists have been interested in answering for a very long time. In his book, The Curse of Cash, Harvard economist Ken Rogoff argues that physical cash can actually negatively affect growth because of at least 3 reasons. One, there is a cost to banks of maintaining ATMs, and according to a BCG report, this cost can be as high as $5 billion per year for a big bank in North America. There is also cost of cash to consumers, which Amiyatosh and Tamanna already talk about in the paper, which is the commute time and ATM fees that consumers have to pay to use cash. And the third reason is the tax gap that is created because of the underground economy that is facilitated by cash transactions. And this Harvard Business Review study calculates the cost of cash using these 3 points, and you can see here in red, India has a very high cost of cash, so ex ante, there is a reason to believe that if India starts using digital payments, there are going to be benefits in terms of economic growth. I was actually curious to see what's the relationship between cash and GDP, so I downloaded data from the World Bank, and I tried to see the correlation between cash to GDP ratio and real GDP growth, and you see that there's a clear negative correlation if you look at all countries. And even if you look at the set of advanced economies for which data tends to be better, you still see a clear negative correlation between the two. Right? But of course, this is not a good exercise to establish causality. There is a lot of endogeneity here, and that's where Amiyatosh and Tamanna's paper comes in, because they try to use an exogenous shock to cash that helps achieve causality, or that goes in the direction of achieving causality. Second, even if we forget about the broader economic question of on the effect of cash on economic growth, I think it's important to quantify the effect of this landmark innovation in payment systems in India. This innovation was massive in both scale and scope, and it made India a global leader in payment system innovation. Now, what are some of the features that make India's UPI unique? First, it allows for real-time payment settlement. There is no fees that is charged to consumers, it's for consumers, it's really, really inexpensive form of making transactions. There are consumer-to-consumer transactions, consumer-to-business transactions. There's an option to both pay and collect requests. There is usability across apps, across merchants, across different bank accounts. There is an open system which allows for healthy competition. So in China, for example, WeChat and Alipay don't have an open system, and therefore there are concerns about market concentration, which is not the concern in India, or not to the same extent. There is RBI oversight, so people feel secure to use the system, and that is why it has picked up after the COVID crisis. And there is centralized regulation, which is different from what you see in the US, where there is state-level regulation of banks. So all the other online apps that you see do have some or the other features that are listed here, but UPI is the only app that has all of these features together, which is what makes UPI unique. Now, this innovation is so important that Google actually sent a letter to the Federal Reserve in November 2019, citing the India experience as a successful template for payment systems innovation in the US. And in fact, in July 2023, the Federal Reserve is going to launch FedNow, which is analogous to the UPI system in India. So that has been the impact, the scale of impact of this innovation. In 2022, real-time payments volume in India was actually higher than in China, making India the fastest growing economy in terms of real-time payments. So I think that there is enough anecdotal evidence about this important innovation, but there is no formal discussion. So Amiyatosh and Tamanna actually provide a very important contribution to the literature by formalizing the discussion and providing us some estimates. So in what follows, my comments are going to focus on the empirical analysis to further sharpen some measurements and mechanisms. So motivated by this discussion in Ken Rogoff's book, one important cost of cash is tax evasion, right? So cash facilitates tax evasion and illegal activities. And I was wondering, how should we think about economic activity before and after cash, given that some of the transactions were probably not recorded officially when cash was in use? And I know that there is no easy way to measure this because any number that you're going to use will have this problem. So I think that for robustness, one thing that you could do is use nightlights data, because even if you're not, it's not prone to the same critique, because if there is more business activity happening, then you will see it in the nightlights, right? Similarly, if there are other metrics that you could use, like pollution, so anything that is not reported directly in the statistics can validate the effect on economic activity. My second concern, which Amiyatosh has already discussed in his presentation, is about heterogeneity in treatment intensity and whether that's random. So the concern is that this heterogeneity in the intensity of digital payments could be correlated with other factors that explain higher economic growth after the adoption. And to address that concern, one test in the paper is looking at self-employed households versus salaried households, and the paper finds that the self-employed households see a higher increase in income compared to salaried households. So now this is much better than the baseline test, but I think still some issue with this analysis, because what if self-employed households adopted digital payments to receive government transfers in the COVID crisis, and that shows up as higher business income? Or what if self-employed households in certain industries that were less negatively affected during COVID are the ones that see higher income? Now, of course, the sample does include the time period before COVID, so this is not completely driven by that argument, but I think it might be useful to include industry fixed effects so that you're comparing households and self-employed people within the same industry, so that this concern about one industry being less negatively affected than the other does not hold. And then if you could use an instrument about based on government encouragement of this adoption in different states, or the introduction or elimination of MDR, that might also be useful in addressing this concern. My third comment is about financial frictions, which is sort of the key mechanism highlighted in the paper. Again, to reiterate the mechanism here, financial frictions, so potential entrepreneurs face financial frictions. So there is credit rationing by banks. They do not get the credit even though they have a good project that they want to implement. Because of information asymmetry, there is credit rationing. And the digital transactions create a financial digital footprint which reduces this information asymmetry between banks and households and induces banks to lend more. And households in digital payment districts, therefore, are more likely to borrow from a bank and use those funds for the business. So this is the key result in the paper. And I think that if there can be more results supporting or more analysis supporting this result, that will be very useful. So I have some suggestions here on what more can be done to support this result. One is the financial constraints are going to vary depending on certain factors. So for example, if you want to start a business which needs a lot of external financing, then financial constraints are going to be stronger. Can you use that information somehow to show that income is higher or business creation is higher in those industries? Similarly, if the household income or wealth ex ante is lower, then again, financial constraints faced by those households are going to be more severe. So that can be used to, again, say something more about the differential business probability of business creation after the UPI launch. And there might be some interesting bunching around monthly transaction amounts or monthly transaction limits. So if there is a limit on how much, what's the total amount that is allowed on the app, and if you do see a bunching around that amount, then that's a clear evidence that there are binding financial constraints. Similarly, it'll be useful to provide some more evidence on information asymmetry. So what are the types of households that are more likely to face this financial constraint? Those that do not have a prior banking relationship. So maybe you can look at in the data whether a household has borrowed from a bank in the past, how many times has it borrowed from a bank in the past, and use that as an indicator of information asymmetry. Similarly, right now, I think you're looking at the amount of transactions as the digital payment intensity, but it'll also be useful to look at the frequency of transactions because the more number of times you transact on the app, the more data your bank has about you. And lastly, it might be useful to provide some supporting evidence on the relaxation of financial constraints using district-level data on change in bank credit. And I don't know if this data is actually available or not, but if you can also show some district-level data on investment and employment, that'll be very useful. Now, this slide has some points on other channels that could also be driving the result, and I would say that Amiyatosh and Tamanna's estimates are probably a lower bound. This was such an innovative change that people could be benefiting from this change through other channels as well, and probably this is just food for thought and maybe points for future papers. But for example, one way in which this payment can affect efficiency is by reducing cash flow needs for firms in the time when they're waiting for funds to be collected from payments, right? So this reduces cash flow issues. They could, in general, be borrowing more from friends and family, right? So that can also help businesses. Corruption is another thing that probably digital payments can reduce. I don't know in which direction it will go. That's, again, I think, a separate paper. Maybe corruption in India helps some entrepreneurs but using cash, but maybe digital payments will reduce that or increase that. We don't know. So that's another interesting channel to look at. Larger tax base. So now if transactions are happening digitally, then probably the government will now have a larger tax base and will have more public funds to invest in physical infrastructure that can support longer-term growth. And then finally, what about consumption spending? Now that I can make transactions digitally, presumably I will, also, my consumption expenditure is also going to increase along with investment expenditure. And that can also increase GDP. But then again, that's probably a separate question. So I'll conclude here. I think that this paper makes a very important contribution to the literature. It quantifies the cost of cash and studies the effect of one of the most important innovations in the financial sector, both for India and also for the global economy. It opens up a lot of exciting avenues for future research, and something that I myself am interested in is understanding better the business model of these payment service providers. What is their incentive to innovate? How much should we be concerned about concentration in this market? If the MDR is eliminated, then do these payment service providers have an incentive to continue innovating? What are the risks that we should be concerned about going forward? Thank you.
Thank you so much, Amiyatosh, and thank you, Isha, for that excellent discussion. I actually had a bunch of questions that you then raised in your discussion, so that... So it just raised so many questions, and I think one of the... I'm sorry, I'm going to take a couple of minutes and ask one of the questions that interested me in particular is that you put up this this graph of business growth that had somewhat stalled after 2021 maybe, and I was curious what you think is going on there. Is it that your right-hand side variable about cashless payment adoption, has it just been sort of saturated, so there's no more adoption that's happening because everybody has already adopted? Or is it something else? And I have something else that I'm curious about, which is that do you happen to see any transitions from, let's say, the sort of informal own account enterprises, these small informal businesses? Do you see sort of a transitioning from that kind of, fruit seller hawker model to perhaps formal employment or movement into the formal sector? So could that be going on? Because that has also been one indicator of higher economic growth, where individuals are moving from sort of subsistence enterprises and subsistence entrepreneurship to formal employment or wage employment or perhaps bigger firms. So that's one of my questions, but I'm not going to ask you to answer that right away, and instead I think what I want to do is open it up to the audience, and we collect all the questions and then let Amiyatosh and Tamanna and Isha answer them. So go ahead, Anjani. Do you have it? All right.
There is a mic there.
Thank you. Really interesting presentation. And so my question, I haven't read the paper, so I have to apologize for that, and I look forward to doing that. So my questions may be completely off the mark, in which case don't hesitate to tell me. I actually have a series of questions, but the first one is about identification. And the concern I have is the same concern as happened when the branch expansion happened in India. At least in rural areas, the UPI, the digital payments, was done hand in hand with the government welfare programs. As you notice, you've said itself that it could have been, but they were really planned to go together. So the big program here is the National Rural Livelihoods Mission. It actually started 2016, same time as this, the transition to livelihoods, and it expanded along with it. So a lot of your results seem to smack of that to me. If I read the paper right, read the results you were showing right, the effect is much greater in rural areas than urban areas, and that's where NRLM is. The effect is greater in the Hindi heartland, which is, again, where NRLM was concentrated. So I think I don't know how you separate out those two. So I guess that was my first set of comments. The second comment was, again, on heterogeneity and this effect that it's going to be, it was larger on the people who had their own business than it was on others. That sort of seems contrary to what you would expect. So if the impact was really to weaken credit constraints, then you would expect the impact to be more on the people, the laborers, not on the people who already have their own salaried business. So if you just ask me who are the people who are credit constrained in India, it would have to be rural laborer households. And a big part of NRLM was actually pushing those households in, so I don't know how that fits in. The third question is about, again, getting back to the methodology, and it's about financial intermediation in general. So the conversation or the way it's been discussed and the paper was about digital payments. But again, going back to rural India, a big emphasis was on savings. And so one of the biggest transactions is actually pulling savings into the system through digital methods. So if I think then again of the literature on financial intermediation, one of the big reasons it's supposed to have an impact is because it disconnects savers from investors. And that means that I should not be looking for effects within a district. They could be completely separated, and so there's no reason to expect everything to be concentrated within a district. I should see a much greater linkage of the whole national market, which you're identifying one part of it, but I would actually think that if this is really financial intermediation, we should have seen an integration of the whole market, and we shouldn't, what we're picking up is just one small component.
Is there another question?
Yeah. Can I ask a question?
Yeah.
Thank you so much for the wonderful presentation, Professor Amiyatosh and Isha. So I have a question, like if we think about three enabling factors, first of them being demonetization, the second, COVID, and third, obviously the surge in digital transactions that you're talking about, it should have led to less cash economy, if not cashless economy. But then we see that if we see the figures pre-demonetization and after demonetization, and it has actually increased by almost 80%. So how do you explain that dichotomy? Is like some other factors going behind the rise of so much cash in the economy?
Okay. Do you want to?
Sure.
Yeah. Unless there's no other questions. On the
All right, thank you. So I'll just take a minute to first thank Isha. Wonderful comments, and certainly we have a lot to do, so thanks a lot. And especially liked all your suggestions on the empirical part, and also liked your suggestion on putting it in the context of broader issue about the curse of cash and Kenneth Rogoff's. So we'll do that, absolutely. Thank you very much. So on the questions, Nandini, on your question about, this is how, you said, so business activity went up and flattened statistically. So that's how we thought about the first interpretation that you gave. That is, you have initial surge, and after that, there is no more extra kick. But then you're also bringing up the second point that we had not yet thought about. We just thought about the first one and stopped. But certainly, we will also see that. Is there a migration from these guys are becoming not self-employed, but they're becoming something like a salary. So we haven't checked that. We'll do that. Thank you very much. Now, great suggestions there. And the benefits transfer is something that we have been thinking about, absolutely. And that is that when digital payment adoption came, then was it helping with more transfers, broadly defined, from the government? So on the issue, perhaps we're thinking about this a little bit differently, that and I'll be happy to talk about it, but the way we have been thinking about is that the credit constraints is really helping those people who want to be entrepreneurs as against labor. So in this way, that is, it's about, some of the results that we show is about borrowing for business. Some of the stuff that we show, I'll come to you in a second, or the borrowing from the bank. And so that is, of course, the economic thinking that we have. So within that, we are doing this identifying assumption. But I'll be more than happy to hear economic channels where that might not be the case and do more about it, absolutely. The related point, the other point that you made about why are you looking at within district year variation rather than national, purely from tying it down a little bit more disciplined in terms of the statistics. But economically, I completely am with you that the implications are much broader, the integration across the market. In fact, we have this whole agenda, and Isha pointed out some of the stuff about that it's completing the markets, of course. So it's like one of those settings where we can go back to the basic Arrow Debreu security kind of stuff that has the markets become more complete in India, has the marginal propensity to consume changed after the adoption of this. So we'll do that, and so I'm agreeing with you that we should do the national thing, but we have not done that yet in this paper.
Can I just make a clarifying comment?
Sure.
NRLM is not a benefits transfer program. It's a program to promote entrepreneurship through credit.
Can you spell out what NRLM is?
So I'm not that familiar, if you could.
National Rural Administration.
Okay.
It's not a benefit transfer
Yeah.
But it's a program to develop entrepreneurship.
Okay.
Starting 2016.
Perfect.
Through credit and access, using digital to access banks.
Okay. So I'll love to talk more about that. And in that case, the question will be that was digital transaction an enabler? The way I'm hearing it, that in that case, the story becomes a little bit nuanced, but digital payment perhaps still helps. If it is about that you're using digital payment to support that, then it will be nuanced that it's a means of payment that allows you to spur economic growth through governmental approval. But absolutely, I'm happy to see more. And if there is data available on that how different districts went on those dimensions, then that certainly will improve our paper. So thank you very much for that suggestion. And the cash amount that you're talking about, it gets a little bit nuanced. That it's we have not done that. Again, very early draft, and the whole literature is very early. But it's not only about the level of cash, but it's the velocity that you have to really think about. That how many times are you churning that cash? So one of the key things that will happen is that how many times are you making that transaction? We haven't done that yet, but we'll certainly look at it. Thank you.
I wanted to think a little bit more about this this notion that Isha brought up, which is that maybe it's government transfers that's driving some of the income results. But I don't see why this contradicts your point, because right now your point is that it's reducing either transaction-related frictions and/or financial frictions.
Right.
So I think probably the government transfers, or perhaps some of these other schemes that benefit individuals, comes in that first mechanism, right? Transaction-related friction. So I don't think that's necessarily a competing hypothesis.
No, not at all. Not at all. It's about the economic channel that we have started with more, I guess, given our backgrounds, naturally, thinking more about the credit frictions. But some of these enablers that we are talking about is more about digital payments reducing the transactions cost of government programs, which is not at all competing or other. It's more about the economic channel. And the point that you are making about that, which I was not aware of, so which I have to read up on, is another form of transactions cost, that the government wanted to promote a program and there was a leakage, perhaps corruption, perhaps you could not reach, and then the digital payment is allowing to do that. So absolutely something to work on.
Yeah, and I think another transaction-related benefit is when you think about it, could also be faster payments. So you have a business and someone says, fine, you give money, you give things on credit, but because they don't have the cash or whatever. But now, especially after the thing that Isha brought up with the amounts, they made a change, right, where they increased the amounts that you could transfer. I wonder whether that is something you could capture as well, which helps small businesses. So they get larger transfers because they increase the limit.
Yeah.
So, and again, I know that goes towards the transaction-related frictions, but I think these are related. I mean,
Absolutely.
the financial frictions.
Absolutely. And Isha's point, and I was quick on that, but some of the comments that you made about looking at the bunching, looking at the changes in the MDR, absolutely we should be looking at those things. And again, as we develop the paper, these are the things that will come, both in terms of the transactions cost, Nandini, and also in terms of better identification. So that the MDR change certainly lowers expands the ability, lowers the transaction cost by definition. So we should look at before and after. Yeah. The only thing I'll say is there's always a little bit of the problem in this kind of a study, that you're looking at a lot of things that have happened. And that's why we like staying focused within district, but then it has, of course, the problem of leaving the national thing. Yeah.
So just 2 or 3 thoughts. I don't know where they go. One, at least one major reform happened around the same time, which is the GST.
Yeah.
And that also was working towards formalization of the economy and all. So this, I don't know how that interacts with what you're doing. On NRLM, actually, one thing you can easily do, of course, is that's a national rural livelihood mission, and so urban is, and you have the distinction between rural and urban at least, and that should give you some variation on that account. Seems to me there's a lot to be done further, perhaps. I mean, you got this whole other PLFS data set is in existence, which I think can let you do a lot of the other things, you are doing, but perhaps some of the other things as well. So this is for your future graduate students. There are also surveys done, right? I mean, when you were talking about, Nandini was talking about these own account enterprises versus the, what are these, establishment enterprises and all. So that's a different set of, questions perhaps there. But most certainly these are pretty exhaustive surveys, meaning that they cover the entire country, and large surveys. So you can probably, if not at district level, certainly you can operate at the state level. That variation can be exploited, and that sort of gives you a nicer, own account versus the establishment enterprises. Different set of questions perhaps there, but certainly related. All of this. That's not a regular survey, so it happens every 5 years or 6 years, but you can certainly get before and after digital expansion. This is a question. Are we talking here about a one-time change in income, or this is actually a growth rate kind of effect that you're picking up?
Yeah, so statistically what we showed you, leaving aside the identification issue, is the growth rate you're picking up. And so you're doing within household fixed effects, so you're slowly saying that, look, so that graph that I had earlier shown year by year is indicative of growth in the income. Of course, these are all great suggestions, but I'll just say that in terms of using other sources of data, nightlight data that Isha you have suggested, each one of them will have some trade-offs, but absolutely, if we can make it more, we can certainly our goal is to make it better and better. So it's on that has always been on our to-do list to look at the RBI data, look at the nightlight data we thought about, but it's like we have not done anything yet. But absolutely. GST, we'll have to think a little bit more about that. How do you separate the two? I'll put that GST or any other scheme as broadly the same identification thread that we have, which is inevitable with some of these important economic questions. That is a trade-off. That is, economically, there is a huge thing that is happening. Statistically, it is hard to identify. So certainly we want to keep our claim a little bit modest. But the basic things like that, is it rural, urban, that we have already taken care of. Basic things like, is it something about the preference of the household, that we have taken care of. It's something about the aggregate economic shock of 2016 or 2020, that we have taken care of. So, but obviously now we are in the domain that something that changed in high intensity districts with GST payment, and that can happen, and that is the formalization of the economy. And that also is a very interesting task, that it can lead to economic growth, but now the channel is not so much the credit constraints, but channel is either the transfer of the government program, reduction in transaction cost there, or better transition from informal to formal economy. Right? So these things are there. Some of this we'll do in this paper, but of course keeping a little bit also an eye on how much you can do on the paper. But these are excellent suggestions. Thank you so much.
Well,
on one of the heat maps that you showed between the states,
Yeah.
couldn't help but notice that two of the states which have relatively high state GDP, Gujarat and Tamil Nadu, seem to have a lot of white spots when it comes to UPI adoption. Is there any explanation for that, or is that just statistical anomalies? Just seemed very striking. I mean, you can see that UP and Bihar, it's easier to understand because it correlates with the level of state GDP, but these are two they'll probably be in the top 5, in terms of per capita state GDP. So how come there's not that much of UPI adoption in those two states, at least from the diagram that you showed?
So on average, there is, of course, higher, more heat intensity in Gujarat and Tamil Nadu, but there are district-level variation even in those states. But we'll dig deeper. We did look at, unless Tamanna, you want to add something here?
Yeah, so what I'll add here is that some states were really early on, they were super eager to adopt to digital. Andhra Pradesh is one of them, and if you could see in the heat map, it was all green. So what Chandrababu Naidu did is that demonetization happened in November, and in December he was out with this new app called AP Purse, which was also leveraging UPI platform, but he wanted it to be only for Andhra, and they were driving it really hard. And states like Tamil Nadu, Gujarat picked up on it, but they were slightly delayed. So the heat map is a percentile ranking, as Amiyatosh pointed out in the presentation, and then we break it down into deciles, and then we plot it. So some states are so high, and they were so eager that we see light green for Gujarat and Tamil Nadu. But your point is well taken. I mean, it's just about the adoption intensity.
Thank you.
But at least Gujarat has some tribal districts, for example, and the tribal population may be concentrated. So that's where I think these districts may be coming through, where even in Gujarat you have districts which have not adopted the.
Yeah.
So, but it's very hard to look at every district. but means that may be in the pockets of poverty and some connected to there being tribal belts. And same may be true in Gujarat. I know that there are tribal belts.
Yeah, see, the only thing is in relative ranking, they are falling behind. So otherwise, on the overall level, they definitely have a large UPI adoption.
I think Praveen has it.
Thank you for excellent presentation and discussion. I share some of these endogeneity concerns, but we can talk about that over the coffee break. But I had a separate question, which is on the measure of the cashless intensity. Do you feel you're losing anything because of the way that that's been constructed? So for instance, if all of these districts have done super well and the spread between them is kind of small, but you're still, because of the measure of the construction, you have to rank them 1 to 100, et cetera, then you might be missing a lot of the action of the principal jump from. Yeah. And so I just wondered if I'm sure you've thought about this, have you played around with other measures of how you construct that to see what else you might get? Thank you.
Yeah, so we looked at multiple.
Just to build on that, suppose you had data on 20 rupees note usage versus 10 rupee usage.
Can you be a little bit louder?
Suppose you had data on 20 rupees note usage versus 10 rupee note usage. What's changed really is the payment instrument, right? And so your mechanism of how that should affect the income has to come from something other than the bills or payment instrument that's being used, right? So your mechanism is somehow that there's new credit creation happening, correct? Now imagine if you had written this paper the exact opposite, which is where in districts where income has gone up more, you have more usage of payment. What would be wrong with that story?
No, nothing will be wrong with that story. And that's the whole crux of the indigeneity, right? That is what you're saying. And in fact, you said it, that something else happened. That's exactly the unobserved variation that, of course, we must tackle, right? And so the whole idea about whether you're looking at within district variation and all is for that. So you can make that argument, and I'm not going to say that's not the case. So the whole point about using some of these heterogeneity is for that. But Praveen, to your question, yes, that's absolutely how you construct it. So the first thing we had, one of the first 2-3 things we did naturally, because the first time you're doing it, it's what's the right way of doing it, right? So once we did, where we simply took the early period, early adopter versus, so it's like people who just started and just sort them based on the early period, soon after 2016, just when you didn't have a lot of zeros, and then you get good results for that, right? Of course, the trade-off there was that, so that looks a little bit good in terms of not getting confounded by after time period. We miss out on some of the later part stuff. But since you thought about it and we had thought about it, perhaps one could do that, just focus on just very early adopter and focus on just a small window after demonetization shock, 2017. That will take care of, now that I'm thinking about it in the response to your question, that can be certainly done. The other one, which I'm not yet sure, is that the natural instinct would be just run a panel regression where you have this digital payment intensity is also going up and you have some economic outcome. So just let X variable also be and Y. And let X variable also be a time varying adoption. We picked this one because we thought this is a little bit less susceptible to that indigeneity that you guys are talking about, is because here we are simply making it as a district characteristic rather than moving that, look, in this quarter income went up or this year income went up and my UPI transaction is going up. So we thought that we are biasing against ourselves, but something to revisit.
Some of it is a question of what that spread actually looks like in levels, because you're then forcing it into a one-to-one, you're forcing it into a 1 to 100 scale,
Right.
as I understood it.
Yeah, that's correct.
And so is that difference a lot that's being, or a small that's being spread out into a 1 to 100 relative to just what that number one looks like? Okay. Right? So that's, maybe I'm not expressing myself clearly, but I think you got my point. Yeah.
So just to expand on what Amiyatosh responded, so the problem here was that UPI was launched in 2016. State governments decided that, then the national government started pushing state governments that you should, adopt it in your states. And by the time they made budget, like inclusion for like pushing UPI. For instance, there was Haryana government came out with, we'll give you ₹5 for every transaction that you do for a limited number of period to promote use of UPI. Then the Prime Minister went out with a message that you should use Bhim Pay for your utility bills. All of this was happening around 2017, 2018, and some states like Telangana, they were making budget, they were accommodating their budget for pushing UPI transactions as late as 2019 January. So, and then COVID happened, and then adoption, some states were, again, after the pandemic hit, some states were early adopters when the pandemic hit, and some states were still lagging behind. So then what we thought is, let's just do the average, like for all UPI transactions for these 5 years. So for every district, the average UPI amount divided by the population number. So that's what we went ahead with.
Okay. So we're out of time, and if anyone has more questions for the authors or the discussant, maybe we could do it to the coffee break. But once again, thank you so much for your comments.